And they invented, in a sense, in a broad sense, what's a new fundamental, which is to say, if you find an asset class, even if it's legitimately overvalued, where the short position is too extraordinary to cover, if you collectively buy up the float, so there's no stock available to cover, you can do some truly odd things to those who are short. I remember Ian McAvity describing being on the wrong side of a short squeeze as being a truly religious experience. And certainly the people who were short GameStop learned that to their disadvantage. It is arguable that the silver futures market may be the most overshorted market in the planet. But remember that in the silver futures market, a short squeeze can always be stopped two ways.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com. Welcome back to Liberty and Finance. We have a returning guest with some renown. Rick Rule is the CEO of Sprott Asset Management. He's joining us this Tuesday, February 9th, 2021. Rick, thanks for coming back on Liberty and Finance.
Always a pleasure, Dunnigan. Thank you for having me back.
We're privileged to have you because our viewers often look to you for seasoned advice on kind of a broader perspective on the natural resources sector in general, not just precious metals, but all things natural resources, and also just investing, speculating, self-protection financially for principles that they need to look after. So before we get into specific viewers' questions, we've been through a rather tumultuous week or two regarding some of the precious metals like silver and some rather interesting news coming out about Sprott announcing hitting a record. I think it was 100 million ounces or something like that, and ready to acquire more. Maybe you could clarify what Sprott's actions are, but then give us a greater context within which you see the silver market supply-demand pressures currently.
Well, you asked a lot in that question, so let's try to take them sequentially. The first part of your question, I think, dealt with what I would describe as normal volatility in precious metals markets. Dunnigan, you remember, and many people listening today will remember rather frequent reference by myself to the Barron's Gold Mining Index, and the lessons one would learn from that. With specific regards to your question, upside volatility and downside volatility, cyclical volatility are real functions in a secular bull market, and you can expect them. If you are unnerved, either don't open your computer or get out of the sector. We will, in the course of what I believe to be the third secular bull market of my career, probably experience 8 or 10 cyclical declines in a secular bull market that will be perhaps 20% declines, 25% declines in the broader equity index. This is difficult for people who haven't lived through them. As your viewers can tell by looking at me in the screen, I have in fact lived through them, and so they're of much less concern to me. With specific regards to silver, I guess I have 3 comments. The first is that this is silver's time. You and I have talked in the last 2 years about precious metals bull markets. And the point I've made is that the bull markets are led by physical gold, by the metal. It moves first because it moves based on fear. When the physical gold moves, it begins to cause people to come into the gold equities, but specifically early on, the biggest and the best gold equities. Silver moves after gold, usually well after gold. The unit cost is less, and the buyer is more motivated, A, by the lower unit cost, but also by greed as opposed to fear because of the extraordinary volatility in silver. The last asset to move in a precious metals bull market historically has been silver stocks. The higher quality silver stocks are particularly volatile because there are so few of them. My friend Doug Casey, with whom you are acquainted, once described the phenomenon where the generalist investor who comes into the precious metals market, and in particular into the silver market, finds a sector where the market cap isn't sufficient to accommodate the cash that comes into the sector, a phenomenon which he colorfully describes as attempting to siphon Hoover Dam through a garden hose. Is that going to happen in that explosive way soon? I don't know about the soon part. All I know from observing history is that if this bull market performs, acts the way that the two prior bull markets in my career have, that certainly a dramatic upside move in silver, while not a certainty, is a possibility that those who can afford it should speculate in. I am myself increasing my position in silver equities, and I would encourage people who are psychologically and financially prepared to accept the volatility inherent in the silver market to consider doing the same, of course, in conjunction with their financial advisor, if that's appropriate.
Mm-hmm. So could you talk to us about maybe some of the specifics people are keenly interested in? And you may probably tell us, hey, it doesn't matter. If you get back far enough from the chart and you look at the 100-year and you look at these long cycles and these ups and downs, you don't need to know the reason for every perturbation. But there's been a lot of interest in the last 2 weeks about why now or what's actually pushing things one way or the other. Do you care to share any insights or opinions that you have about that?
Well, I think there are three things that one must realize. I think the place that you're leading me is to a potential short squeeze and the GameStop / Robinhood crowd. And I'll deal with that last because I think it's frankly least important. Probably simply the most important is that economic and social and political conditions, as we've described before, are extremely bullish for precious metals. There is nothing that moves precious metals like debasement of the currency. I would suggest that most of the tapering off in precious metals prices and the sentiment for precious metals that we've observed in the last 4 weeks has been the fact that the yield on the 10-year U.S. Treasury is less negative, which is to say interest rates have risen. The fact that interest rates were able to rise in the near term without really compromising the economy has led to people having more faith in savings instruments and feeling less need of gold and silver. When I look at that response, I get it. The yield on the U.S. 10-year Treasury has basically doubled. But it's worthy to note that the U.S. 10-year Treasury still yields like 1.1 in a currency that's depreciating by 1.6 a year, which is to say the U.S. government absolutely positively guarantees to cost you 0.5% a year in purchasing power on their savings. One of the few promises, by the way, Dunnigan, that in your lifetime or my lifetime, they will keep. So I think that speculators and investors both need to examine the reasons for the bull market, and then they need to examine their own psychological and financial preparedness with regards to taking loss. They need to look at the Barron's Gold Mining Index, and they need to decide from their own viewpoint whether what I would describe as perturbations, which is to say 2 or 3 months, 20% declines, matter in the context of markets that have reliably returned 500 or 600% over 10 years. There are some people for whom the 10-year quest for a 500% gain isn't sufficient to endure the psychological disutility of a 20% paper loss in 3 months. And to the extent that people are honest with themselves and save themselves the trauma, more importantly, if they're my clients, save me the trauma of having to handhold through that circumstance, I think everybody's better off. Now, let's deal with the Robinhood crowd finally, because this has been just an amazing phenomenon. for me to see. And I think in one sense it's wonderful. The idea that a younger generation decided not to get their paradigm, not to get their news, not to be force-fed strategies from on high, from the investment banks, from the popular press. Rather, they decided to get it from each other. And they invented, in a sense, in a broad sense, what's a new fundamental, which is to say, if you find an asset class, even if it's legitimately overvalued, where the short position is too extraordinary to cover, if you collectively buy up the float, so there's no stock available to cover, you can do some truly odd things to those who are short. I remember Ian McAvity describing being on the wrong side of a short squeeze as being a truly religious experience. And certainly the people who were short GameStop learned that to their disadvantage. It is arguable that the silver futures market may be the most overshorted market in the planet. But remember that in the silver futures market, a short squeeze can always be stopped two ways. One, by doing what they did to the Hunts, which is to say by changing the rules. So you literally can't buy, you can only sell silver. A different way would be to change the margin requirements, which they could do. And the third would be to insist on cash settlement, which is to say that the exchange would set an arbitrary market-related price after they halted trading and would settle trades for cash rather than for silver. So it's people who need to who believe that the outcome in the silver short market would be the same as the outcome in the GameStop market need to understand that they would probably need to marshal 200 million ounces in contracts held for delivery, which, at $20-something an ounce represents a not insubstantial commitment. And they also need to be willing to take the risk that the big thinkers of the world would do to them what they did to the Hunts, which is to say, go to cash settlement or change the basics of the game. None of this matters, by the way, with regards to the silver thesis over time. It goes more to the impatience of speculators and investors today, which is to say they think the fact that they want something positive to happen within the next week or two is somehow relevant. It isn't. That isn't the way the world works, although it's a highly amusing distraction.
You mentioned so many things in there. There's one thing that jumped out at me, and that was the transition from centralized top-down investment guidance to grassroots, basically strategizing. Let's swarm over here. Let's swarm over there. I was distressed over the past couple of years, but not entirely surprised to see some specific evidence of different investment advice being given to high net worth clients or groups rather than to the retail investors. I shouldn't have been surprised, but could you just touch on that for the moment? I mean, for example, people are learning, if they followed you at any length of time, they've learned that they get a more seasoned insight into the natural resources space by either attending the Sprott Symposium or by sending you their portfolio for your free ranking and comments, that sort of thing, than they do by just watching random podcasts from any old channel. So we know that there's different quality of information that's available that people can avail themselves of. But I didn't realize that it was actually tiered intentionally as different product suites for different financial classes, that sort of thing. Could you at least touch on what people should be aware of in that regards?
Well, sure. The first thing with regards to, we'll call them peer-to-peer or non-traditional forms of information. There are so many opinions out there, and in fact, there's so much information out there that what investors need to do in order to access it is to categorize their own thoughts, build a sort of a road map, a game plan. And then I think those same investors and speculators need to do the same sort of due diligence on information sources that they might formerly have done with regards to companies. Now, of course, Donegan, people don't want to do that. It smacks of work. The idea, we've discussed this on past podcasts of yours, speculators pay slavish attention to asset prices without having any basis of understanding of the value. And if you don't have any feeling with regards to value, the price is in effect irrelevant. Money's made on the delta between price and value. So what's incumbent, I think, on investors and speculators is, first of all, to develop a bit of knowledge, and more importantly, perhaps, a philosophy of investing, and maybe even a philosophy of life, so that then you can categorize information sources according to their utility to you, and also to their veracity. I really like the fact that there are a plethora of voices now. When I was a young man, there was the Wall Street Journal, the Wall Street Journal, the Wall Street Journal, and the Wall Street Journal. Then on the scene comes Agora as an example, and of course many other financial medium, but Agora was sort of the outlaw, the bad boy, which meant that it gave pretty interesting advice. Now there's thousands of voices, many of them, quote, free. So one thing that investors and speculators have to do is they have to understand that if a product or service is free, they are the product. It might be that the site is advertising or sponsor supported. People have said to me, why on earth would you at this stage of your life grade 22,000 portfolios last year? The truth is that portfolio grading is a fairly sophisticated form of advertising for me. I engage in discussions with investors on a topic that they're fascinated about. No esoteric discussion of the gold price, but rather the efficacy of their own investments. And as a consequence, I have the opportunity to prove my worth. I'm advertising not with money, but rather with time. So to the extent that that is free, understand that my hope that this is an effective marketing strategy, and by the way, it is, means that nothing is free. I just believe that an advertising strategy that gives the recipient value up front is a much more honest advertising strategy than if I were to say buy banner ads in Barron's magazine. So I think it's important to understand all those things. Understand the motivation of your news source, your information source. Understand something about the way he or she has interacted with the market in the past, what their specific expertise is, and guard too against what Robinhood itself seems to be about and Reddit is about, which is to say narrative. If I had a criticism of the speculative market that we see in front of us today, it's that it's much too oriented towards narrative and not oriented enough towards arithmetic.
You didn't talk on one of the things that I thought you might, and that's the people just being aware that some of the retail level, so we talked about this peer-to-peer or free or just kind of independent private sources, but there's also this commercially available and very widespread. I mean, you can hardly go into any strip mall or wherever, anywhere in the country and not see at least one, sometimes more than one, retail investment advisory shop. And that's what I was referring to, was that I became aware because I saw some publications that weren't intended for those retail customers, but for a higher level of customers in the last couple of years.
Well, certainly everything you said there is true. There's a plethora of people that would like to sell you investments or investment advice for a fee. Some of them are more competent than others. There are also gradations on the type of advice which is available. The level of discussion that Sprott can have, where the customer is a sovereign wealth fund, the regulatory requirements for that discussion are very different than the regulatory requirements we might have for a younger speculator who wasn't yet accredited. The discussion that we can have with a high net worth or ultra high net worth investor, particularly a high net worth investor who is a client of a family office that has a third party representative in the conversation with us, Similarly, has fewer restrictions in terms of what we can say and what we can advocate. So the stratification of top-down advice, at least where it comes from the financial services community, is, as you describe, very different depending on your expertise, your domicile, your net worth, that kind of thing.
It's interesting because I think a lot of the ordinary people aren't aware of that. You don't find out about that, what's behind the curtain, until you get up closer to those levels.
And that's not a bad thing necessarily. I think of some of the advice that I've received over the last 40 years from some of the largest financial institutions in the world. And I would have been well advised to ignore at least half of it. It is important, as I say, to invest in your own knowledge and your own philosophy before you spend too much time absorbing too much paradigm from other people, irrespective of their brand, including mine, by the way. If you aren't psychologically prepared to deal with the time frames and the volatility involved in what I do, you probably shouldn't listen to me.
You mentioned something else in passing that I was trying not to smile too broadly, because it reminded me, you said most people don't do that work on their own philosophy, their own research on the people from whom they're going to take advice, that sort of thing, because it takes work. And it reminded me, we visited quite often. In fact, we used to be members at the Greenfield Village in Dearborn, Michigan, founded by Henry Ford, who was good friends with Thomas Edison. In fact, they've moved Thomas Edison's Menlo Park Laboratories there. And there's a quote on a board there from Thomas Edison saying, "Most people miss opportunity when it knocks because it comes dressed in overalls and looks like work." So,
Guilty on occasion, Duncan.
Yeah, of course, aren't we all? We do have some specific questions from viewers. This one's about the broader economic conditions that are affecting the markets and will going forward. Andrew Lautier asks, Rick, you've mentioned in previous interviews you believe there may be a recession before commodities or other than precious metals really turn into a true bull market. If the current run-up, presumably driven from government, quote, interventions, pulls back, and we would assume the government would again step in and try to fix/fudge this. Does this mean you believe the government intervention will be ignored next time around, control lost, and the system would forcefully correct itself?
Your questioner needs to understand that I've been a consistent skeptic with regards to government action and liquidity, which is to say I've been consistently wrong. Between Doug Casey and I, we've accurately called 17 of the last 3 declines. And history will show that I'm perhaps too skeptical about this. The truth is that we're in a circumstance where the market is buoyed by liquidity. Being both old and a lender, I'm very cognizant of the difference between liquidity, which we have in abundance, and solvency, which only a few of us have, and we don't have collectively. My nervousness is that liquidity works in the system as long as investors ignore solvency. Many investors are very prepared to ignore solvency because it requires them to act and be afraid, which they don't want to do. They want to believe that Janet Yellen has their back or something like that. I need to say I'm fond of quoting people, as you know, and with regards to my own near-term track record, with regards to liquidity and solvency and its impact on commodity prices over the last year, I need to quote the great Patsy Cline when she sang, "I was so wrong." I missed a major move in the iron price. I missed a major move in the copper price because my concern was that we're in a recovery that's driven by liquidity, not by solvency, and also because I believe that financial markets probably haven't costed in the impact of the COVID-19 virus. The truth is, when capital is freely available and real interest rates are sub-zero, which is to say when investor and speculators' cost of capital is sub-zero, anything can happen in the markets. Buffett himself, who I wouldn't describe as a bear, suggests that negative interest rates are not a force of nature. They're a construct of man, and they're a false construct. And he said that an investment strategy that is based on sub-zero cost of capital is one that, at least for a time, will end in tears.
There's been a lot of talk. Before the silver talk, there was a lot of talk about cryptocurrencies for the previous month or two. Mm-hmm. And this is an interesting perspective. This is a Google user who is looking at how does this play out. It says, Rick, I'm in the position that there's going to be a huge run-up in Bitcoin. When that happens, the powers that be will make it illegal to own it. Governments will never want to have a competing currency coexist with their national currencies. When that happens, I suspect that much of the capital will go from cryptos to precious metals. What are your thoughts on this?
That's above my pay grade, probably. One thing I would note is that the market capitalization of Bitcoin, I guess, is approaching $1 trillion. If something happened that were to cause a precipitous decline in Bitcoin, given that it's valued in US dollars, there won't be very much capital left to redeploy. If the price of Bitcoin, as an example, were to fall fairly precipitously from, say, $40,000 or wherever it is to $7,000 or $8,000, all that money goes to money heaven. It's not redeployable. And so the idea that there is a massive shift out of Bitcoin into gold in the circumstance where Bitcoin was arbitrarily devalued by government is probably a false hope, because that money literally goes to money heaven. If the price of Bitcoin, and I'm not saying it will, by the way, don't quote me, but if the price of Bitcoin were in some circumstance where governments made it illegal or difficult to use, if the price of the Bitcoin were to suffer a precipitous decline, the capital wouldn't be left to redeploy. I continue to believe that Bitcoin competes with gold only on the margin in terms of their demand, because both of them individually, and in fact both of them combined, are a minuscule asset class relative to other savings and investment products that are available to people. And while certainly Bitcoin competes with gold for the Robinhood user, Bitcoin doesn't compete with gold for major pension funds, major endowments. They may have them, but they have them in a different part of their portfolio than they have their gold. So I think there's probably lots of room for both if you pay attention to arithmetic rather than narrative.
Before I have a follow-up question on that last part, but back to the first part where you said after a precipitous decline in a previously soaring asset, that capital is no longer available to get redeployed. I mean, isn't it the case that when something is peaking, it's because that Hoover Dam of capital is trying to crowd into that space, and so that same amount of Hoover Dam of capital has to leave in order to cause that precipitous decline?
Well, in truth, you find that prices are set on the margin. The so-called float to transaction volume is what's important. And so the marginal buyer, that extra 3 or 4% of demand, in the absence of supply, can cause those hockey stick graphs. What's important to know in precipitous declines is that it doesn't take much of a preponderance of sellers over buyers. In other words, assets that are extraordinarily volatile can rise or fall on relatively small volumes relative to the total float. And when that happens in that circumstance, the float is devalued without any of the float holders getting any liquidity out of it on the way out, with the exception of, say, the marginal buyers and sellers, 3 or 4%. People believe that an asset class with $1 trillion in it has $1 trillion in it. But that isn't the case when the price falls precipitously. The whole asset class gets devalued with nobody, at least nobody statistically, getting very much liquidity out of it on the way down. It just collapses.
Now, you've talked in the past about your strategy. You said, yes, I don't give personalized investment advice in this format, but that when you made something to the effect of, when you start to think you're so wise because you've gotten into a sector, whether it's natural resources or whatever, that might be a time to start tapering out of it, and before that precipitous decline arrives that you're describing.
I have found that I'm served better by fear, which is to say, when the logical side of me is all over something because I like the arithmetic, but the emotional side of me is afraid because there aren't an awful lot of people validating my opinion, and the market price of the asset isn't validating my opinion. When I'm in that circumstance, I do well. When I begin to take solace from the fact that asset prices are rising, validating my opinion, that is to say, when I'm less afraid and more confident, I've noticed that it's time to check my premise again. It's taken me a long time to go there. Everybody wants to feel like they're smart, and everybody, too, deludes themselves in the sense that we all think that we're sort of empirical, that we search the universe for facts, things like that, and we judge them all impartially and we make conclusions, which is ludicrous. That's not what we do at all. We look for information that supports our existing paradigms and prejudices. And we have recency bias, too, which is to suggest that something that happened to us yesterday has a stronger place in our memory than something that happened to us a year ago, which is a long way of saying that we resist history. And you need to guard against that every single day. You need to guard against recency bias and at least consider history. And you need to say every single day, if I'm confident about something, why? What's changed? Why do I feel better about it? Particularly, why do I feel better about it when it's up by 50% or 60%, which in an arithmetic sense means it's 50 or 60% less attractive.
Right.
It's very difficult to do that. I think I've said this on your show before, Dunnigan, but it really resonates to people. And I assume that yours is a traditional family, that your wife does most of the shopping. If your wife went to the store and she found a brand of tuna fish that your family liked, and the tuna fish was, I don't know, $2 a can or something, and it's a brand that she knew and trusted and stuff like that, and she thought that represented good value, she'd buy enough for a week or two and bring it home. If she, as a rational human being, went back to the store a week from now and saw the same can of tuna marked up to $4 from $2, she'd be furious. She'd buy canned chicken. The fact that the price doubled without any change in the tuna would make her justifiably angry. But when one of your subscribers buys a $2 stock and it goes to $4 with no change in the underlying value, they're elated and want to buy more. Coming back to tuna fish, if as a consequence of the tuna being overpriced, people stopped buying it and the store had to mark it down to $1 to clear their shelves, your wife would go back to the store, and the fact that a $2 can of tuna fish was now on sale for $1 would mean that she would buy so much that your car would be rear-loaded. It would be heavy in the trunk. But if one of your subscribers buys a $2 stock and it falls to $1 with no underlying change in value, they're disgusted. We buy tuna fish rationally, and we buy financial assets stupidly.
Well, I think one of the biggest missing pieces there that you baked into your model, your metaphor there, was that the intrinsic value, and that's back to the work or the person that you've done the work
Right.
to trust, that kind of thing. So
right,
yeah,
it's fine. I do this a lot. I do some what I would describe as anticipatory pricing. I'm not as aggressive with my anticipatory pricing as, say, Eric Sprott might be. But when I construct a net present value model of a gold mining company, I might run one net present value scenario with $1,250 gold, another net present value with $1,750 gold, and then I allow myself a $2,000 or $2,200 case. I don't know which of those it will be, but the fact that I at least have a framework for value gives me a huge advantage over investors whose mantra is got a hunch, bet a bunch.
Interesting. Now, we'll circle back in a minute to that whole discussion in the context of some news that came out about Sprott announcing additional action. But first, I wanted to hit this question from Donald Orphy Jr., who says, is there enough silver in the ground to meet the future demand? Solar panels, electric cars, smartphones, etc. for silver. Can the miners mine enough silver to meet demand?
Yes. There is lots and lots and lots of silver in the Earth's crust. If the silver price rises substantially, two things happen. One is that fabricators will find a way to use less. The market will cause them to conserve. At the same time that the metallurgical processes by which we extract silver, as an example, from copper or lead or zinc ores, will improve, and we will find more silver. It's inconvenient, perhaps, because it's messy, but markets work. The cure for low prices is low prices. The cure for high prices is high prices. And to the extent that demand for silver increases, which I believe it will, as a consequence of its utility as a germicide and as a reflectant substance, I believe that the market will easily accommodate the demand, just at a different price point, higher.
Right, and that opens up your point is that also that not only will industrial reengineering potentially diminish the inefficient uses of it to make it more sure they're more efficient, materially efficient, but also there'll be new opportunities for some of those miners who now they can justify certain operations at a different price point than they could have at the current price point. So,
correct. Both is true. Markets work. They're just not as predictable as we would like.
All right. So now this question is related to about markets working because there's been a loud chorus of voices for some time claiming that the markets aren't even markets really, that they're fictitious markets and so on. There's various scenarios to support that claim. Neil Curry asked, he said, Rick, there was a interviewee named Jeff Christensen on the Miles Franklin channel who talked about an argument that precious metals market manipulation is an illusion, a myth, and a product of weak minds, evidently. What say you?
I'm probably, and this will expose me to a lot of hate from your network, I'm probably more in the Jeff Christian camp. Listen, I believe that all markets are from time to time manipulated, even U.S. dollar markets, which are the deepest and most liquid markets in the world. Trading desks, although it's illegal, manipulate markets in the short term all the time, literally all the time. Now, I have seen precious metals markets in the near term manipulated up too, not just down. The idea that some silver market participants have that there is a broad spread scheme or scam to depress the silver price or depress the gold price over time is something that's very hard for me to understand. First of all, in my own experience, in my youth working for very large financial services firms, the strategy of the firm, most people won't want to hear this, but it's driven by near-term cash bonuses to employees and a long-term scheme, say a decade-long scheme to depress the price of silver, which would require selling silver short, which would require making interest payments and reducing EBIT and therefore quarterly cash bonuses to the executives at the great big financial services firms, seems highly unlikely to me. The second part goes more to competence. If we assume that the government is part of this nefarious scheme, how is it that a group of people that can't deliver the mail, can't educate the kids, lost the war in Vietnam, lost the war on drugs, lost the war on poverty, can win the war against the silver market? These are people who, as Doug Casey famously says, were it not for senior appointed positions in government, would likely be wearing masks when they went to a 7-Eleven. The idea that this group has the competence to manage the scheme that they are alleged to have taken part in makes no sense to me. Are there structural problems in the silver market? Certainly. The daily volume in the futures market is often 250 times the amount of physical supply for good delivery. So to the extent that a well-capitalized trading desk establishes a position in the futures market, long or short, and then acts in the physical market in a way that changes the physical market and reprices the future, if you're talking about 250 to 1 leverage, the idea that this didn't happen I think is extremely naive. But understand that this happens in a very episodic fashion. People who are interested in this aspect of the silver market look at the extraordinary dumps that take place, where people sell large amounts of physical gold or silver in the overnight market when the market is the thinnest. That is absolutely, I believe, done to manipulate the futures market. But I think in terms of a decade-long directional bias, that the structure of the financial services business around their cost of capital, and more particularly around quarterly cash bonuses, makes it extremely unlikely that there's a thorough, ongoing conspiracy to manipulate the price of silver, either up or down.
So, talking about the long-term price of silver, you and Sprott take, I would say, strategic and deliberate actions that you've deliberated on for some time before moving. Can you update us on that news story that came out about the 100 million ounces of silver and further actions announced by Sprott?
Well, I can't comment too much because it revolves our physical products, which I am constrained with regards to commenting on as a consequence of the fact that I'm frequently in possession of material non-public information. I can only say that Sprott has been a large and continues to be a fairly large participant in the physical silver market. I'm delighted to say that while the silver market is effectively sold out of retail quantities of silver, which is to say, although silver is very difficult to buy retail without enormous premiums, the wholesale market for silver allowed Sprott, as the news release suggests, to add in excess of 100 million ounces of physical silver in response to volatility in the silver market. That isn't to say that our traders didn't have a couple of sleepless nights acquiring that silver. I am also, I think it's fairly obvious that despite my fairly sober tone, I believe that the wind is in precious metal sails. And I believe that precious metals are climbing a wall of worry, and that there will be more capital coming into precious metals markets and precious metals equities markets. And that means that I believe that the overall bias in those markets is upwards. And with regards to the quality equities, likely over the next couple of years, sharply higher. So yes, I'm a gold bull. And yes, I'm a silver bull. And yes, I'm a bull on gold equities and a bull on silver equities. It would be easy for me to believe that I was a year early on silver. That doesn't mean that I am. It just means that I've earned humility over the last 45 years in these markets by being sometimes early, seldom late, and often wrong. And I believe that it is more likely than not that, as an example, silver trades higher and silver equities trades higher. Am I going to put 100% of my net worth in silver-oriented penny dreadfuls? Of course not. But I am going to make a bet, am currently making a bet, based on my own suppositions that metals prices go higher and that historically silver, while it's moved later, has outperformed gold, and that the silver stocks do the best of all. This is not carte blanche, by the way, to go look at the 60 or 70 penny dreadfuls in the silver equity markets out there, many of whom don't actually have any silver. They're looking for silver. There's no suggestion that if the silver price goes up, the share price of a company that doesn't have any silver should, as a consequence, go higher, although it might on narrative. But as we've discussed in prior shows, the silver equities have been very good to me in my life. Just to get people's blood racing. I remember, as an example, financing Pan American silver at 50 cents a share and watching it go to $45. Similarly, Silver Standard, I think, was 72 cents to $40. The idea that somebody like me, who has experienced this in the past, and believes that over the next 2, 3, 4, 5 years, that the silver price goes higher and the equity prices of high quality silver companies goes higher, the idea that somebody in my position wouldn't allocate a reasonable amount of capital around that bet is sort of silly. Whether or not your listeners should do it is really a function of their willingness to do some work, separating the good, the bad from the ugly, and their ability to do what we described earlier in the show, which is to say, sit in place for what will certainly be a very bumpy rodeo. When I talk about the fact, as an example, that Pan American went from 50 cents to $45, if my memory serves me correctly, 4 or 5 times during that move, the price of Pan American fell by half, which is to say, owning the stock from 50 cents to $45 was anything but a smooth, uneventful ride. So people who want those quantum gains have to be fairly adept at accepting periodic pain.
You made me remember, because you mentioned earlier in this very discussion about, you said you're anticipating larger streams of capital waking up and coming in and joining into this market in the time to come. Because before, when you talked about Hoover Dam trying to squeeze through a garden hose, I forgot to ask you, could you give us your assessment? You've given us a very high level, like 0.5% of the overall investments are in natural resources and natural resources related equities. Specifically, retirement funds. There's a lot of people nearing retirement or hoping to be nearing retirement in the U.S. The baby boomer generation and so on, and solvency is something you've brought up. You've used the S word, the solvency, several times as far as the Social Security is not going to be or whatever. And these funds that were making assumptions that they could get 7% returns on their treasury, but no, we can't do that anymore. So how many of these funds, in your estimation, have already gotten clued into the fact that they maybe should have some participation in natural resources or precious metals specifically, or how many do you think will be if they haven't yet?
I'm optimistic and frankly relieved that the institutional investors around the world are looking to precious metals, particularly government-sponsored institutions. You need to understand that bets on precious metals are, in one sense, citizens hedging themselves against their government.
Right.
And to the extent that a government-related pension fund can overlook the fact that this is sort of an indirect swat at him or her, requires some intellectual courage that is encouraging to me. I have fairly recently been talking to some large government-sponsored institutions whom we've been talking to over 10 years. And one institution, by the way, I won't name them, had an allocation suggestion from their pension consultant, their actuarial consultant, 3 years ago to have zero exposure to precious metals. None, negative, zip, nada. Now, that same fund, which is a very large fund, suddenly has said that they are looking to build a 3% position. That's interesting in the sense that the statistic that you described earlier, which is to say that not natural resources, but merely precious metals and precious metals related equities comprise less than 0.5% of savings and investment assets in the United States of America, whereas the 3-decade mean was between 1.5% or 2%. It's normal in a bull market for the markets to overshoot the mean. So to the extent that rather than having precious metals market share stop at 2% on the way to recovery, which is to say the mean, it wouldn't be unusual at all to see that market go to 4%. The reason, or one of the reasons, pardon me, that I believe the institutions are going to be forced into precious metals, separate and apart from their efficacy, is the fact that institutions manage about $100 trillion worldwide. And their mantra for 30 years has been 60% equity, 40% debt. The idea being that in poor economies, when the equities fell, the interest rate would fall, which would increase the capitalized yield of their bond portfolio, and the bonds would go up. That works fine as long as you're getting a coupon on the bond. You accommodate the time value of money with your bond holdings, which can't go up, at least in terms of principal. They can in terms of price, because you get an income stream. But if that income stream is negative after inflation,
Right.
And you have a 30-year liability to your pensioners, you can't afford the negative yield on those bonds. Now, that isn't to say that $40 trillion in bonds are going to be sold and that those people are going to buy gold. All I'm trying to say is that there will be disintermediation out of fixed income assets, and one of the beneficiaries is highly likely to be gold and silver. If you get a small share of a $40 trillion print, it's a large amount of money.
Well, I wanted to give you a chance to let people know how they can get that free advice that you talked about earlier that you've offered to our viewers and that they've taken you up on as far as grading their portfolio, how they can do that.
Well, I'm delighted that you gave me the opportunity. And yes, it's in fact advertising. I just believe that I should give you something before you make up your mind as to whether you're going to do business with me. The consequence of that is that any of your viewers or listeners who would like to avail themselves of the opportunity should go to a website, www.sprottusa.com/rankings. Enter your natural resource equities. Please, no pot stocks. Please, nothing I don't understand. I will rank your holdings 1 to 10, 1 being best, 10 being worst. And I will comment on individual issues where I think that my comments might have some value. In addition, if you put in the request charts, I will send you the Barron's Gold Mining Index chart, and I will send you a 100-year commodity chart that shows, I think graphically, how cheap industrial commodities are relative to other asset classes when you compare the relationships going back 100 years.
And folks, if you want to get onto our free newsletter that comes out 3 times a week with all of our guests and links like guests provide, such as the ones that Rick just mentioned, make sure you go to libertyandfinance.com. Over in the left-hand side, put your name and email address, and we'll get you signed up for our free email. There's no obligation and no cost. And Rick Rule, CEO of Sprott Asset Management, there's so many questions we didn't get a chance to ask you this time, but we'll have to have you back. And just thank you for joining us again on Liberty and Finance.
I enjoy the process. Thank you so much for the conversation. I've told you before, it's a pleasure to be interviewed by you. Sometimes I, in the course of an interview, spend the whole interview trying to make the interviewer seem not so stupid. And in fact, you ask highly intelligent, highly interesting questions. So I want to thank you for making the process pleasant.
Flattery will get you nowhere. Okay, thank you for joining us, Rick. Very grateful for your presence.
Thank you.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.